Welcome to The Explainer. Look, today we're tearing down one of society's absolute biggest, most persistent myths. This devastating lie that building wealth is exclusively a young person's game. You know the narrative, right? The idea that if you haven't totally figured it out by your 40th birthday, well, the window is quietly closed. The financial industry actually loves this narrative because, frankly, it keeps people passive. But today, we're diving into the data, the specific strategies, and the math that definitively prove building $1 million portfolio in your 50s isn't just possible. It actually comes with some massive built-in advantages. Because it really all boils down to this one anxious question, doesn't it? Is 50 just too late to build $1 million? It's that sinking feeling of looking at the calendar and panicking. But as you're going to see, the people who actually pull this off, they don't let this question paralyze them. They completely reframe it.
To really ground this, I want to introduce you to Robert. He's going to be our sort of narrative anchor for this explainer. At 54 years old, Robert was sitting in a financial planner's office with exactly $67,000 saved to his name. That's it. He had spent his entire 30s raising kids, his 40s paying for their education, and he was totally convinced he'd completely missed his window. He looked like a guy who had already written the ending to his own story. But here's the thing. Robert hadn't missed his window at all. He had just been playing the wrong game.
To fix his financial foundation, Robert used a highly specific 5-step roadmap. And that is exactly what we're going to unpack today. Mindset, math, income, risk, and the goal. Let's jump right in.
Step 1 is all about mindset and what we call the late start illusion.
We have this tendency to idolize youth in finance. But think about it. A 25-year-old with a massive head start, they still have decades of expensive, terrible decisions ahead of them. When you're starting at 50, you are not starting from scratch. You are walking in armed with what's basically supernatural pattern recognition. You already know which business ideas are going to drain your life, which relationships are toxic, and which of those brilliant dinner party investments are actually going to quietly destroy your wealth.
And I absolutely love this quote. It hits the nail right on the head. Judgment cannot be downloaded. It is built from error, observation, and time. Listen, your experience isn't some consolation prize for missing your 20s. It is literally the most valuable asset in the room. You've already paid the wildly expensive tuition for your life mistakes. Now, it is time to cash in the diploma.
Which leads us perfectly into phase 2, the math. We're talking cost-cutting and compounding. So to make this work, you really have to understand the compression window. Think of building wealth exactly like a massive construction project. For years, it's just dirt and concrete pouring into a hole, right? Totally invisible groundwork. Then suddenly, the floors go up exponentially fast. Wealth compounds the exact same way. The massive visible acceleration happens in the final third of the process. If you can invest $1,500 a month starting at 52, assuming a 9% return, you hit $1 million portfolio by 67. But, and this is a big but, it requires you to respect the math right now. Waiting even 4 years exponentially damages that final skyscraper. Now, where do you find that extra capital? Check this out. This is a case study of a guy named David who performed what we call expense surgery. Notice his income didn't change one bit. It stayed flat at $96,000. But David went through 12 months of bank statements with a fine-tooth comb and aggressively cut those habitual, automatic lifestyle costs he didn't even realize were running in the background. Without dropping his actual quality of life, his annual savings skyrocketed from $4,200 to $26,000. You don't necessarily need to earn your way to $1 million right off the bat. A lot of times, you can just operate your way there by trimming the fat.
Okay, moving on to section 3, income. It's time to monetize that experience. You have got to start leveraging the irreplaceable skill premium. The market pays you based on how difficult you are to replace. But most people in their 50s, they've spent decades building this incredible niche expertise, and then they just sell it wholesale to a single employer for a flat salary. Remember Robert, our guy from the beginning? He had 22 years of logistics knowledge. At 56, he finally repackaged that exact same niche expertise into independent consulting for multiple clients. Within 18 months, he completely replaced his old salary, worked fewer hours, and poured all that extra capital straight into his investments. But look, consulting still requires you to physically be there. The next structural shift is crossing the income diversification line. This is where the magic happens, where you finally separate your time from your money. Whether you do it through dividend-paying index funds, a single rental property, or digital assets, you need income that compounds while you sleep. Your physical presence always has a ceiling. Structural income doesn't.
All right, section 4. Let's talk about risk.
and specifically, avoiding wealth traps.
Failing to reach $1 million by 65 is rarely about making tiny little accounting errors. It's almost always about allowing massive, entirely preventable leaks to destroy your foundation. Imagine trying to fill a barrel that has a giant hole in the bottom. You can be incredibly disciplined, carry water every single day, pour it in faithfully, and you will just be constantly, endlessly frustrated by how slowly it fills. That hole, that's high-interest consumer debt.
The math here is just devastating and completely unambiguous. You literally cannot invest $800 a month in a market returning, say, 9%, while simultaneously carrying $30,000 in credit card debt that's costing you 24%. That is not investing. That is controlled financial deterioration. Closing that hole in the barrel, meaning aggressively eliminating that high-interest debt, has to precede any serious investment activity, no exceptions.
And here is another huge risk trap: failing to respect the protected decision zone. When life hits you hard with a massive emotional event, a divorce, a job loss, a scary medical diagnosis, your decision-making machinery is completely compromised. The rule here is incredibly simple. For 6 to 12 months after a major trauma, you make absolutely zero large, irreversible financial decisions. You don't liquidate your assets. You don't randomly start a business. You just wait. Disciplined decision-making means letting your mental machinery return to normal operating temperature before you make a move. You also really need to audit your environment. Look at the stark difference between James and Michael here. James spends his time with people hyper-focused on visible consumption. You know, the new cars, the lavish vacations. It becomes this unconscious lifestyle competition, and it quietly drains his wealth. Michael, on the flip side, deliberately surrounds himself with wealth builders, people who read annual reports, who talk about long-term strategy. Make no mistake, who you spend your time with is either actively accelerating your progress or quietly dismantling it. Actually, this next reality check is kind of heartbreaking. Thomas was doing everything right. He was perfectly on track for $1.1 million, but he completely ignored his health for 20 years. At 65, he suffered a massive cardiac event. Between the $190,000 medical bill and 2 years of lost productivity, his reality was brutally slashed down to $620,000. Listen, physical health is not some optional lifestyle preference. It is literally the most critical financial asset on your balance sheet. Your body is the machine that builds the wealth. Take care of it.
And that brings us to our fifth and final section, the goal, the final destination.
First off, you absolutely have to embrace the simplicity premium. I see so many people build these incredibly complex portfolios with like 12 different account types and massive color-coded spreadsheets. And sure, that architecture works beautifully right up until life gets busy, and then the whole thing collapses under its own weight. Real financial intelligence is actually surprisingly boring. It's simple. 2 funds and 2 accounts that you can manage in 10 minutes a month, that will forever beat some complex optimal strategy that you end up abandoning after 2 years.
Next, you need the written number. Way too many people over 50 are just out there chasing this vague, fuzzy feeling of security or stability. But guys, you cannot navigate to a feeling. If you do, the horizon is just going to keep moving and you will totally exhaust yourself. You need a specific, exact number physically written down on paper. What is the exact monthly income from your investments that you require to stop working? A finite number can be systematically achieved, a feeling cannot.
Which brings us right back full circle to Robert. Remember? The guy who sat in an office at 54 with just 67 grand thinking his financial life was basically over. By ruthlessly following this exact framework, by cutting the hidden costs, monetizing his niche experience, patching the holes in his barrel, and keeping his investments boringly simple, Robert hit his 65th birthday with a final scoreboard of $1.1 million. The math absolutely works if you actually follow the system.
But you know what's amazing? When Robert called to celebrate, he didn't even talk about the money. He talked about his lack of fear. He talked about the quality of his relationship with his daughter. He talked about finally having time. Because the $1 million, it's not the destination. It's just the ticket. It's the ticket that gets you into a completely different kind of life. A life where you get to make decisions from a position of real strength rather than pure exhaustion.
So I'm going to leave you with this final provocative thought. Most people over 50 are just sitting around waiting for a sign. They're waiting for someone to give them permission to start, but the clock is running. So what is the one specific, concrete decision you are going to make this week to finally leverage your late start advantage? Stop waiting. Pick one thing, close the hole in your barrel, and start building.